Do you dream of mastering the stock market without risking your hard-earned money? In The Intelligent Investor, Benjamin Graham presents timeless principles for achieving financial success through disciplined investing. This book isn't about getting rich quick, but rather building wealth sustainably while minimizing risk. Graham's teachings, which are the foundation of value-based investing, have influenced countless successful investors, including Warren Buffett. If you like this summary, don't forget to support us by subscribing to the channel and clicking the like button. Stay tuned to the end of the video for more recommendations for books that contain similar ideas. Similar to The Intelligent Investor by Benjamin Graham. Graham begins by making a clear distinction between investing and speculation, a difference that many people often overlook. Investors versus speculators. Investors focus on the long-term value of assets and invest in them. By carefully analyzing businesses and their growth potential, speculators chase quick profits by betting on price movements. Graham warns that speculation is similar to gambling, entertaining but unsustainable. For example, an investor might analyze a company's earnings before buying its shares, while a speculator might buy only because the stock is trending upward. The margin of safety is one of Graham's most important concepts. It involves buying investments at prices far below their intrinsic value. This margin acts as a hedge against unexpected declines. Think of it as a bridge designed to carry twice the expected load. You'll be prepared for the worst. For example, buying a stock whose intrinsic value is $50 at $30 creates a margin of safety. Emotions are the enemy. Graham emphasizes that emotional reactions, such as fear during crashes or greed during rises, lead to bad decisions. Successful investors remain rational, buying when others are fearful and selling when others become excessively greedy. For example, the 2008 financial crisis created opportunities for those who stayed calm and invested in undervalued assets. Market movements don't reflect value. Stock prices fluctuate daily based on sentiment and speculation, but a company's true value changes slowly. Graham advises ignoring short-term price fluctuations and focusing on fundamentals like earnings and market position. For example, despite temporary declines, Amazon's value has continued to rise due to its strong fundamentals. The idea is that investing isn't a short-term game, but a long journey. Stay steady, plan wisely, and rely on a margin of safety. Graham presents Mr. Market, a vivid metaphor for understanding market behavior that isn't expected. Who is Mr. Market? Mr. Market is like an unbalanced business partner who makes you daily offers to buy or sell your stocks. His mood is extremely volatile. Some days he's overly enthusiastic and overvalues stocks, while other days he's pessimistic and undervalues them. Graham teaches us that your job is to benefit from his fluctuations rather than be influenced by them. Volatility is your ally. Volatility often scares new investors, but Graham sees it as a blessing. When Mr. Market undervalues a stock, you have an opportunity to buy. Likewise, when he overvalues it, you have an opportunity to sell. For example, during market corrections, high-quality stocks are often temporarily undervalued. Avoid the herd mentality. Graham advises against following the herd. Herd mentality often leads to bubbles and crashes, as happened during the dot-com bubble in the late 1990s. Instead, investors should think independently and focus on data and logic. Intrinsic value is the anchor. Understanding a stock's intrinsic value helps investors resist Mr. Market's volatile behavior. By analyzing a company's financial health, earnings potential, and industry trends, investors can determine whether a stock is undervalued or overvalued. For example, Warren Buffett is famous for only investing in companies with strong intrinsic value. The idea is that Mr. Market is unpredictable, but you don't need to be. Use its volatile propositions to your advantage. Payette and Graham offer two different approaches to investing, each suited to a different appetite for risk and a different appetite for risk. Conservative investors are guardians of their wealth, preferring stability and avoiding significant effort. Graham suggests focusing on a balanced portfolio of high-quality bonds and well-reputed stocks. For example, investing in dividend-paying stocks or government bonds provides consistent, reliable returns with low risk. Conservative investors avoid speculative bets and stick to established companies with reliable performance. Active investors are proactive and opportunistic. Active investors are hunters willing to spend time searching for undervalued stocks with growth potential. Graham emphasizes that this strategy requires extensive research and careful analysis, along with monitoring market trends. For example, discovering a small tech company with innovative products before it gains attention can yield significant returns, but this approach is not for beginners, as it involves risks. Top role diversification. Don't put all your eggs in one basket. Diversification is an indispensable rule for any type of investor. Conservative investors can spread their money across different sectors, while active investors may combine high-risk options with stable ones. For example, combining investments in real estate with a market index fund reduces overall risk while providing sustainable growth. Diversification acts as insurance against unexpected market fluctuations. Setting clear criteria is a compass for decision-making. Graham emphasizes the importance of setting strict investment criteria. These criteria may include consistent growth in earnings, low debt-to-equity ratios, or a strong competitive advantage in the market. For example, refusing to invest in a company with unstable earnings ensures a disciplined approach, free from emotional decisions. A clear, rules-based strategy helps investors navigate the complexities of the market with confidence. The idea is whether you are conservative or active. Success comes from adhering to a wise diversification strategy and setting clear, actionable criteria. Along with methods, Graham focuses on the mindset and discipline required for long-term investment success. Think long-term. Patience pays off. Investing is not a sprint, it's a marathon. Graham advocates holding investments for years, even decades, to realize their full potential. Markets may rise and fall in the short term, but quality assets grow steadily over time. For example, Warren Buffett's long-term investment in Coca-Cola for more than 30 years generated amazing returns. Patience allows investors to ride out temporary setbacks and benefit from compound earnings growth. Be skeptical, but don't be. A pessimist questions everything. Skepticism is an investor's best friend, allowing for careful analysis and avoiding traps like overvalued stocks. However, Graham warns against excessive pessimism because it can blind investors to real opportunities. For example, an investor who is skeptical of high valuations during a bull market might dig deeper into a company's fundamentals before making a decision. A balance between caution and curiosity is key. Discipline trumps market timing. Stick to your plan. Graham emphasizes that trying to time the market is risky with uncertain outcomes. Instead, he recommends adopting a dollar-cost averaging approach, investing regularly with a fixed amount regardless of market conditions. This approach balances the ups and downs, ensuring stable asset accumulation over time. For example, investing $500 monthly consistently in an S&P 500 index fund over 20 years can build significant wealth, regardless of short-term market fluctuations. Invest in yourself. Knowledge is your most important asset. Continuous learning is key. The intelligent investor Mark Graham encourages reading financial reports, studying industries, and understanding economic trends. For example, mastering how to read corporate earnings or learning the basics of economic indicators can dramatically improve investment decisions. Education builds confidence, sharpens judgment, and ensures readiness to adapt to a changing market. The right mindset is the foundation of successful investing. Be patient, maintain discipline, and never stop learning. If you like this summary, check out the following books: Common Stocks and Exceptional Dividends, Philip Fisher; Rich Dad, Poor Dad, Robert Kiyosaki; Think and Grow Rich, Napoleon Hill; The Millionaire Next Door, Thomas G.